Hi, I'm Chad, and in this video, I'm going to provide a Q3 update for the industrial real estate market. My theme for this video is that the market can best be described from the first line of Charles Dickens' famous novel, A Tale of Two Cities. It was the best of times, it was the worst of times. I'm a glass half full kind of guy, so let's start with the positives by pointing to Prologis, one of the largest property owners in the world. Prologis owns nearly 1 billion square feet of industrial real estate, so some pundits regard them as a bellwether for the industry as a whole. In their recently released edition of the Industrial Business Indicator, they announced a number of records are being set in their portfolio. This includes record customer demand, record absorption, and a record pace of rent increases. Prologis is even predicting their rental rate growth will exceed 10% in 2021. It's no surprise then that their stock has appreciated roughly 30% from the beginning of the year. And we could look at NAIOP's Q3 report for further evidence that it's a good time to own industrial real estate. The authors of the report are forecasting that total net absorption for the second half of 2021 will be 162.6 million square feet and 334.6 million square feet in 2022. To put that into context, demand for industrial space in 2021 will finish as the best year dating back to 2014, and next year is projected to do even better. But I feel it's important to look beyond these quick headlines before concluding the market will be facing low vacancy rates and higher lease rates for the foreseeable future. Let's dive into this deeper to see why there's always more to the story. First, Prologis primarily owns warehouses. If you've watched any of my other videos, I stress how important it is to break industrial real estate into three subcategories: warehousing, manufacturing properties, and flex properties. Check out this video up here if you want to learn more about this topic. Warehouses are undoubtedly in high demand right now. There are many reasons driving this demand, but at a basic level, it's a combination of consumers ordering more product online, which subsequently requires more warehouses to facilitate, as well as many companies increasing their inventory levels to avoid future stockouts. And while there are a number of similarities between warehousing, manufacturing properties, and flex properties, they're ultimately designed for separate and distinct uses. Amazon is one of the biggest users of warehousing space, and we've all seen pictures or videos of how these buildings are set up. They primarily use a warehouse to pack as densely as possible with racks and racks of products, with stuff coming and going all the time. Now contrast this to a manufacturing facility, and I'll use a steel fabricator as an example. They might only have a few things coming in and going out, whether it's raw materials coming in or finished products going out, but their primary business is going to be manufacturing, fabricating, or assembly. You can see how there'd be different demand profiles, whether it's a manufacturing property or a warehouse as a result. Furthermore, the vast majority of Prologis' properties are heavily concentrated in large markets, and more specifically, they focus on high growth and high barrier markets, with Los Angeles, New York, Chicago, and Toronto being a few examples. By them strategically focusing on these markets means they expect them to outperform other markets. Or, stated another way, smaller and medium-sized markets might not experience a similar growth. What I'm trying to get at here is that Prologis' statistics, as impressive as they are not necessarily representative of the rest of the industrial market. So if Prologis is expecting rent increases to 10% for a warehouse off a port in Los Angeles, that doesn't necessarily mean that an old manufacturing facility in Midland, Texas will see the same increase. Macroeconomic trends are always going to be important, and I own Prologis stock primarily because I follow them so closely. The stock seems very high priced to me at the moment, but I'm keeping skin in the game because their market intelligence is simply that important to me. I'm not endorsing it as an investment, I just know I want to follow it more closely since I'm actively involved in it already. What I try to glean from Prologis' information is a high-level, 30,000-foot view of the market, but it's also imperative to look more granularly at your specific market or any markets you're interested in. And while it's undoubtedly a good time for industrial landlords, by the very nature of it being an environment of rent increases, we really need to look at this as a two-sided coin. The other side of the coin is that companies leasing the space now have to pay more for rent. This is probably fine when companies are seeing their profits rise, but I think we also need to be cognizant that many companies are seeing record profits coincidentally at the same time when the entire economy is flush with government stimulus. I certainly don't want to overly simplify a complex process, but considering so much money has been injected into the system, it shouldn't be surprising that the number of companies have benefited from it, as we're seeing in the market. Conceivably, governments across the world are going to have to turn off the money printer at some time, and it's anyone's guess how profitable all these companies will remain. So back to my earlier point, companies are able to stomach rental increases when they're profitable, but what happens once profits recede? Industrial real estate, and I can generalize and say commercial real estate as a whole, is worth some function of what tenants are willing to pay to lease it. So what happens if companies cannot financially justify these seemingly quarterly increases in rent? And in addition to increased rental expenses, many companies are having difficulty even getting product. Even the inventory that is en route is stuck somewhere in traffic. Right now, there are over 350 ships stuck waiting outside of ports, and this is up 100% from earlier in this year. And to make matters worse, the product that is arriving is being accompanied by skyrocketing transportation costs. So a situation might be brewing where some companies simply won't have anything to sell, and if that's combined with tighter margins due to increased expenses and inflationary pressures, are developers building space at numbers that might not be sustainable? These are all questions my crystal ball is simply too murky to predict. And I say this not to cast shade on the industrial real estate market. I'm regularly reminded that I do that enough with some of the stories I've told about myself and other investors losing money. I'm a big advocate of this industry. It is literally all that I think about. So much so that when I drink wine, I drink industrialist wine and I drink industrial park beer. I even have some industrial real estate stickers. It's simply a cautionary tale that as good as the market seems right now, and it does seem very good, that it's also worth looking at the blind spots before making any decisions. I'm really hoping that's what my channel will become. In addition to studying all the trends and factors impacting the market, I'm also interviewing a number of industry experts to get their thoughts on the industry. So I'll end this market update asking if you could please hit that subscribe button below to follow along on this journey. Thanks for watching. Catch you in the next video. Hopefully this isn't not off to a good start. Whole thing again. Right there's good. Strategically picking high level 30,000 square foot. I always want to say square foot.